Let's get one thing straight. History doesn't repeat itself exactly, but it certainly rhymes. Mark Twain understood this principle a century ago, and it applies perfectly to today's financial markets. We're witnessing a convergence of historical patterns that has preceded every major market correction over the past 50 years. In 1999, during the massive dot-com bubble, Warren Buffett wrote a prophetic article for Fortune magazine where he warned that the stock returns over the next 17 years would likely be around 6% annually, far below the 12% that experienced investors were expecting at the time. He was ridiculed by market commentators and dismissed as out of touch with the new economy. Yet less than a year later, the bubble burst, the S&P 500 nearly halved, and the actual annual return over the subsequent 17-year period was a mere 2.77%. What did Buffett see that others missed? He recognized a pattern of irrational investment behavior that has historically led to market crashes. He compared the internet stock mania to previous technological revolutions like aviation and automobiles. While these innovations transformed America, most early companies in those sectors eventually went bankrupt, leaving investors with nothing. Fast forward to today, and we're seeing remarkably similar patterns playing out with artificial intelligence stocks. The euphoria surrounding AI has pushed the Magnificent Seven tech companies, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, to eye-watering valuations. Together, they now account for over 30% of the S&P 500's total weight, creating a dangerous market concentration not seen since the dot-com era. Howard Marks, the legendary investor and co-founder of Oaktree Capital, recently published a memo titled On Bubble Watch, where he highlights the striking similarities between today's market environment and the one in which Buffett wrote his famous Fortune article. According to Marks, we're witnessing the same psychological patterns that have preceded previous market bubbles. What exactly defines a market bubble? As Howard Marks explains, a bubble isn't just about valuations or price-to-earnings ratios. It's primarily a psychological state with four key characteristics. First, there's highly irrational exuberance. We're seeing this today with investors piling into AI-related stocks regardless of fundamentals. The recent Trump presidency has only accelerated this trend, with his pro-business, anti-regulation stance fueling even more market optimism. Second, there's outright adoration of the subject companies. Look at how the financial media treats companies like Nvidia and Tesla. They're portrayed as unstoppable forces that simply cannot miss. CNBC and financial publications feature them daily, treating their CEOs like visionaries who can do no wrong. Third, there's a massive fear of being left behind, the classic FOMO syndrome. Retail trading accounts are being opened at record rates, with everyday investors rushing into tech stocks and cryptocurrencies. Brokerages report that their most frequently traded stocks are Tesla, Nvidia, Palantir, and MicroStrategy, all riding the AI and crypto waves. Fourth, there's the conviction that for these stocks, there is no price too high. We're seeing this with the price-to-earnings ratios of the Magnificent Seven. Some are trading above 50 times earnings, and in Tesla's case, over 180 times earnings. These multiples reflect the belief that future growth will justify any price today. These psychological patterns are almost identical to what Buffett observed in 1999. In his Fortune article, he wrote, "Once the bull market gets underway, and once you reach the point where everybody has made money no matter what system he or she followed, a crowd is attracted into the game that is responding not to interest rates and profits, but simply to the fact that it seems a mistake to be out of stocks." A survey from mid-1999 showed that the least experienced investors, those who had invested for less than 5 years, expected annual returns over the next decade of 22.6%. Even those who had invested for more than 20 years still expected nearly 13% annually. The reality? They got a negative 20% return over the next decade, excluding dividends. One critical similarity between today's market and previous bubbles is what Howard Marks calls the newness factor. Stock market bubbles frequently form around new technologies or concepts that lack historical precedent. But why do bubbles tend to form around new things? The answer lies in how investors typically value assets. When evaluating stocks or industries with long histories, investors can look at past performance and establish reasonable valuations. History serves as a psychological anchor that prevents values from becoming too detached from reality. However, when something is genuinely new, like AI today or the internet in the 1990s, there's no historical tether. Artificial intelligence represents a technological paradigm shift that, like the internet before it, promises to revolutionize every industry. This lack of precedent allows enthusiasm to run unchecked, pushing valuations to stratospheric levels. Marx aptly compares today's situation to Hans Christian Andersen's The Emperor's New Clothes. In this classic tale, con men sell the emperor an allegedly magnificent suit that only intelligent people can see. In reality, there's no suit at all. When the emperor parades naked through town, the citizens pretend to admire his clothes for fear of appearing unintelligent. Only when a child innocently points out that the emperor is naked does the spell break. This is precisely what's happening with AI stocks today. Most market participants would rather go along with the shared delusion that's making investors wealthy than avoid skepticism and appear foolish. However, as with all bubbles, eventually someone will point out that the emperor has no clothes. Let's take a closer look at Nvidia, the poster child of the AI boom. The company's stock has surged over 1,500% since 2020. Making it one of the most valuable companies on Earth with a market cap exceeding $2.5 trillion. Its P/E ratio has expanded to over 50, reflecting investors' belief that its dominance in AI chips will continue indefinitely. As Howard Marks points out in his memo, Nvidia's high multiple highlights three key assumptions. First, that the company will remain in business for decades. Second, that its profits will grow substantially throughout those decades. And third, that it won't be supplanted by competitors. However, persistence is difficult to achieve, especially in technology. Of the Nifty 50 stocks that dominated markets in the 1970s, only half remain in the S&P 500 today. Look at the top 20 S&P 500 companies in 2000. Only 6 remained on that list by 2024. And of today's Magnificent 7, only Microsoft was in the top 20 24 years ago. This is the fundamental problem with today's AI narrative. Investors have already decided that these 7 large tech stocks will be the primary beneficiaries of the AI revolution. Yet most of these companies aren't currently generating significant profits from AI. They're spending billions on it. The only one truly profiting from AI today is Nvidia, which sells the chips that everyone else is buying. But history suggests that the early leaders in a technological revolution aren't always the ultimate winners. In the 1990s, companies like AOL, Yahoo, and Netscape were internet pioneers, but they were eventually eclipsed by latecomers like Google and Facebook. The same could happen with AI, where today's leaders might become tomorrow's laggards. Between 1995 and 1999, the NASDAQ 100 doubled in price every 2 years, a pace that seemed absurd until we look at recent history. Since its bottom in late 2022, the NASDAQ 100 has gained approximately 100%, essentially doubling in just 18 months. When we overlay the price action from the late 1990s onto the last 2 years, the similarity is striking. The difference is that the NASDAQ sustained its gains for several additional years during the dot-com era before the eventual crash. On a valuation basis, the NASDAQ 100 is now trading at a price-to-earnings ratio of around 30, a level only seen during the mania of the dot-com bubble. This valuation is similar to where the index stood in October 1998, which was closer to the end of the dot-com bubble than its beginning. Yet from that point, the NASDAQ still climbed another 234% before reaching its final peak. The gap between technology stock valuations and the broader market is also widening, mirroring the late 1990s. While this divergence concerns many experts, history shows it could grow much larger before a correction occurs. Beyond psychological patterns, there are concrete indicators flashing warnings similar to previous market tops. The 10-2 Treasury yield spread, a reliable predictor of economic downturns, recently experienced its deepest inversion since the early 1980s. This indicator has successfully forecasted every U.S. recession since the 1970s, including the dot-com crash and the 2008 financial crisis. Wall Street analysts' long-term earnings expectations for technology stocks have reached extreme levels not seen since the late 1990s. They are now forecasting technology sector earnings to grow by 25% annually over the next 5 years, a rate that history suggests is highly unlikely to materialize. These inflated expectations create a dangerous setup where even strong performance might disappoint the market. Another troubling sign is the concentration risk in major indexes. The top 7 companies in the S&P 500 now account for over 30% of the index's total weight, a level of concentration that exceeds even the dot-com bubble's peak. This imbalance creates systemic risk, as any problems with these few companies could trigger broader market declines. Insider selling at major tech companies has also accelerated to levels not seen since 2021. Corporate executives who have the best visibility into their company's futures are cashing out at record rates, a pattern that often precedes significant market corrections. With all these warning signs, should investors sell everything and run for the hills? Not necessarily. Even during the dot-com bubble, when Warren Buffett correctly identified market excesses, he warned against trying to time market moves. In his 1999 Fortune article, Buffett wrote, "I want to make one thing clear going in though. I will be talking about the level of the market. I will not be predicting its next moves. Even then, valuing the market has nothing to do with where it's going to go next week or next month or next year, a line of thought we never get into." Buffett understood a fundamental truth about markets. In the short term, they're voting machines reflecting sentiment. But in the long run, they're weighing machines measuring actual value. This principle eventually bursts most bubbles, as valuations ultimately converge with reality. The challenge for investors today is balancing risk management with the fear of missing out on further gains. History shows that markets can remain irrational longer than expected. In the late 1990s, investors who exited too early missed substantial gains before the eventual crash. Howard Marks offers 3 guiding principles for navigating potential bubbles. First, it's not what you buy, but what you pay that counts. Second, good investing doesn't come from buying good things, but from buying things well. Third, there's no asset so good that it can't become overpriced and thus dangerous. The difficult reality about bubbles is that there's usually a grain of truth underlying the mania. In 1999, the internet was indeed revolutionary. Today, artificial intelligence likely will transform our world. However, the validity of the technology doesn't guarantee returns for investors who overpay. What do you think about the current state of the market? Are we in another bubble, or is this time truly different? Share your thoughts in the comments below, and don't forget to subscribe to the channel for a more in-depth analysis of financial markets and investment strategies.